Hey everyone, and thanks for jumping back into the Macroverse. Today, we're going to talk about the most recent report on unemployment and the effect that that will likely have on the Federal Reserve and, of course, risk assets. If you guys like the content, make sure you subscribe to the channel, give the video a thumbs up, and also check out the sale on Into the Cryptoverse Premium at intothecryptoverse.com. You'll get access to the website that you see, as well as a lot of other things. There's other videos on my channel that show you more about what you'll get. Let's go ahead and jump in. So, for those who haven't been following the unemployment rate, the reason we want to follow the unemployment rate is because once it starts to go up in a meaningful way is likely when we get our recession. You might say, well, we've been in a recession already, and be that as it may, based on 2 consecutive quarters of negative GDP, even if you use that, that's in the past, right? I mean, we're back to GDP that is expanding again and putting in new all-time highs. So with that in mind, it is clear that the U.S. economy, despite what you may think, is still relatively strong. The unemployment rate came in at 3.7%, which is a slight move up from the month before at 3.5, but the month before that was also 3.7. And you can see that basically the entire year has been between around 3.5 to 4%. So it's too early to say whether this has any sustained move to the upside on the unemployment rate or not, or if it's just noise and it will continue to sort of oscillate around 3.7, 3.8% or so for months to come. Again, the reason why this is important is because it's not until the recession is achieved in recession or in bear markets that include recessions that the S&P 500 typically bottoms. You'll notice on this chart, if you just pause the video and you look at all the different places where we had recessions, it is within the recession that the S&P 500 bottoms, with the exception of the dot-com crash, where you had another subsequent crash in 2001. If you think about what happened, over here we sort of bounced over here, and then going into 2002, I should say, we had another lower low. This could have been the low, right, in September of 2001. But if you remember back then, there was a lot of fallout from what happened, and arguably it led to another lower low, even though it seemed like that could actually be the low back in September. So you can see so far, we haven't actually had a recession, not a real recession anyways, not one where it's really being felt overall in the U.S. economy. Now, the counterpoint to all of this, as I've said before, is to say, well, Ben, you're not really considering 2 consecutive quarters of negative GDP. And again, as I already said, if you want to include that, then you can say we had one, but we're no longer in a recession, and we're back out to positive and continuing to put in new all-time highs on real gross domestic product in the United States. So the reason why we need to talk about unemployment in general is because the Federal Reserve will likely continue to point towards a relatively tight labor market as the reason that they can continue to raise interest rates. Now, I've said before, I don't think they're making a policy mistake. I just simply do not. I think the policy mistake was made last year when they didn't raise interest rates. If they had raised interest rates last year, even by 25 basis points or 50 basis points, you could argue that it would have had a much more meaningful effect than raising it by 25 or 50 basis points today. But the problem is that the Federal Reserve waited too long. They made a mistake, and now we are basically getting the consequences of that mistake in 2022, and will likely continue to feel the effects of it in 2023 and maybe even beyond that. So the unemployment rate has ticked up just a little bit. If you go look at some of the other things, right, we've added 261,000 jobs in October. So, I mean, you can see that it is sort of slowly going down, but it is a sign that the U.S. economy still remains relatively strong. And if the economy remains strong and the job market remains tight and wage inflation continues to persist, then we're likely going to continue to see inflation overall continue to push higher. Now, it might feel like we've been in a recession all year to investors because the markets have mostly just been down. even as of, the last week or so, we've had major tech stocks putting in new 52-week lows, like Amazon, like Google, like Meta. So it certainly feels like we're in a recession from that standpoint. But if you think back to 2014 and 2018 in the cryptoverse, we had bear markets back then that were also not part of a recession, right? 2014, 2018, neither of those were actual recessions in the US economy, but it didn't stop the market from going down quite a bit. So I do think it's an important consideration to remind ourselves that over the last decade or so, the whole economy has been really strong, and we haven't experienced a pullback like the ones we've experienced before, and we haven't seen, or at least not in a long time, and we haven't seen the unemployment go up in any meaningful way since the pandemic, and that was quickly pushed back down with all the money printing that occurred. So ultimately, I think the Federal Reserve will continue to push interest rates higher until it actually has a meaningful effect on inflation. Now, the other thing we should go look at is inflation, because we are going to have another report next week. There's never a dull week. We also have midterms next week. Surely going to be another volatile week, but why should next week be any different? If you look at November 10th, we're going to get another CPI reading, and consensus on headline inflation is around 8%. So it's slightly lower. Headline inflation is moving in the right direction, although it is going at a relatively slow pace. While it is important to look at headline inflation, I think what more people are going to be looking at is the core inflation rate. I've often said I think that the core inflation rate is going through a double peak pattern, just like Bitcoin USD did in 2021. I could see this pushing just a bit higher. I'm not yet certain if this 6.6% is the actual top. If you think back to headline inflation, a lot of people thought 8.5% was the top. We pulled back for 1 month, and then we accelerated the 2 months after that. So that's also a potential outcome, right? You see it maybe pull back for a month and then go 2 months more where it goes back up. And that could be in line with holiday spending or something like that, where you see it push higher. Maybe it comes back down and then you see it push back higher. But in fact, the consensus on core inflation is only it's 6.5%, which is very close to the 6.6% that we saw last month. This website that I'm using suggests that it could be 6.7%. If we see a pretty big pop on this and it goes up to 6.9 or 7% in the next month or two, then I think you could easily make the case that the top is in on core inflation, and then we're just going to have to stick around with trying to figure out how long it's going to take to sort of slowly come back down. So this will also have huge implications on what the Federal Reserve will likely do in December. And speaking of, it's always good to check in on what markets are saying. Right now, there's about a 57% chance we're going to see a 50 basis point rate hike, and a 43% chance we're going to see a 75 basis point rate hike. Hasn't really changed a whole lot. It's more or less just been moving around that 50-50 milestone. Earlier today, they were right around 50-50, and it just sort of keeps moving up and down. But right after the CPI reading is when you see a lot of these probabilities really start to change. And so November 10th, so next week, we'll likely see these probabilities change quite significantly. If core inflation comes in extremely hot, you'll likely see this the probability for another 75 basis point rate hike go up. If it comes in relatively weak, then you might see the 50 basis point rate hike probability go up. But that, I think, is what is worth watching over the next week or so, because it will have implications on risk assets. And I mean, I know a lot of you guys are watching the overall markets, and I mean, again, as I said earlier, as we've been talking about, like Google has been putting in new lows, Amazon has been putting in new lows, Meta has been putting in new lows, Tesla, not new. I don't know if it's put in a new low yet, but it is getting relatively close, and so on and so forth. Even Apple. I mean, Apple has been not putting in new lows yet, but it is really starting to sort of test the boundaries down here at these prior lows over the last 52 weeks. So, given all this, there still will likely remain macro headwinds for risk assets for months to come, right? Months to come. And if you think about average bear market length, if we don't have a recession, you can make the case that the average bear market length has already, we've already hit it, this bear market, and you can make the case that the bottom is in. However, to some degree, you are fighting the Fed with that, because even Powell himself said that the window for a soft landing is narrowing. And I think the reason he thinks that is because despite all they've done over the last year with raising interest rates at record paces, despite rolling off assets off their balance sheet, inflation remains high. Core inflation was putting in a new high just last month. There is no indication yet that the economy is actually slowing down in any meaningful way. Unemployment is still low. We're not really seeing any clear signs of a recession yet. Obviously, markets are forward looking, and the S&P 500 remains in a macro downtrend until proven otherwise. I mean, until proven otherwise, this is ultimately is what I think. I mean, I think it's just in a macro downtrend until proven otherwise. And by the time the world wakes up and sees just how bad things are, that's when you likely see major bottoms on these major indices, and that is when major bottoms are formed, not when we're still at a phase, typically, at least historically speaking, where unemployment remains relatively low. I mean, again, if you look at prior times when the unemployment rate was relatively low, the market was normally at all-time highs. Maybe not all the time, but a lot of times when the unemployment rate was low, the market was at all-time highs. And it was over here too. I mean, it was at all-time highs as well. And you might wonder, well, normally when you start to see the unemployment rate go up in any meaningful way, that's where it really marks the top, right? When once it really starts to push higher. The reason why this time looks somewhat different is because the Fed, they just simply were not raising interest rates when they should have. For instance, if I show you, let me show you a couple of cool charts here. So if we were to go over here, let's go ahead and put on recession areas so we can see what that looks like. And then we're going to go over here and put on, let's put on inflation and just add that to the chart. And then we're going to also add the U.S. effective interest rate. We want to add that to the chart as well. We'll switch that to the same y-axis as inflation, and we'll go ahead and zoom into that area. Normally, when inflation is going up, the interest rates are sort of trying to exceed it, right, to bring it back down. But we're so far behind the curve right now that you could still argue the Federal Reserve has a lot further to go. The problem, and again, if you go to the major indices, let's go look at the S&P 500 and add it on to this chart. So if we add on the S&P 500 here, which is the yellow line, let me actually switch that to a different color. Maybe it doesn't blend in nearly as much. Normally, I'm going to go ahead and hide inflation. Normally, when the economy is strong, interest rates are going up, right? So normally when the economy is strong, interest rates are going up. You can see this happen many, many times. But in 2021, interest rates weren't going up when they probably should have been going up because the economy was strong. And that's why I keep saying, right, it was the policy mistake was last year. They're so far behind the curve that the downtrend already started before unemployment rates started to go up, because they should have started raising rates last year to actually sort of mitigate the risk of inflation sort of becoming entrenched, which is what they're trying to get out of now. And so sort of tying this all back into the main topic of the video, and that is the unemployment rate. As long as the unemployment rate remains low, like it is, I think you can continue to make the case that the U.S. economy remains relatively strong. And as long as the economy remains relatively strong, the Federal Reserve is likely going to continue to raise interest rates, even with a lot of people not wanting them to. Think about all the pushback they've gotten so far. It has not stopped them from doing 4 75 basis point rate hikes in a row, and I commend them for it. I think that's ultimately what is needed. I think a lot of people want them to pull back on it, but listen, I don't think a world of high inflation is really what you want to live through, if I'm being completely honest. Okay? Because if you get something like that, I think it's going to be a lot worse if it becomes entrenched. And just to show you one last chart as to why I think that, let me go put back on U.S. inflation here. And then I want to add on just the stock market. So let me go add on the stock market as well. When you get periods of high inflation, the stock market tends to just go sideways. Okay? I don't really want that, right? I don't really want to just see the stock market go sideways for a long time. So it's important. It's very important that inflation come back down in a meaningful way. They do not loosen too soon, and they tighten until inflation starts to come back down. And as long as the unemployment rate remains low, they still have the luxury to do that. The problem The problem that I think, we have to start wondering about is, and we've talked about this before, is what happens when the unemployment rate starts to go up and inflation is still not coming back down, right? What happens then? Do they print? But if they print, they're just going to bring inflation back. This is why this is such a tough position for us to be in, right? It's a very tough position for the economy because the solution to sort of fix rising unemployment would also likely create the problem that we were trying to get out of again. And that's what happened back in the 70s, right? We loosened too soon and then inflation came back, and then we tightened and then we loosened again and then inflation came back. We don't want to repeat that same mistake. And I think Powell is trying to avoid that same mistake. So anyways, hopefully you guys enjoyed the content. The unemployment rate still remains relatively low. It is slightly higher from where it was last month, so we'll see if it continues to move up or not. But I do think the Federal Reserve will likely continue to tighten for months to come, and it will provide at least some short-term headwinds for the stock market. If you guys like the content, make sure you subscribe to the channel, give the video a thumbs up. Remember, you have the sale on Into the Cryptoverse Premium at intothecryptoverse.com. You'll get access to the website, as well as three videos every single week, a newsletter, etc. So make sure you check it out. See you guys next time. Bye.